Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everybody, it's Nicole Benjamin, your host here at Seeking Alpha, to bring to you another episode of our series Portfolio Pulse, where, as the name suggests, we're going to be keeping a pulse to all the big financial moves happening in the market. Now, for today's episode, we're joined by none other than Joe of Grassroots Trading. Now, Joe, thank you so much for joining us today.
It's great to be here. Thank you for having me.
Absolutely. Now, Joe, I see you've been on Seeking Alpha since 2016. So tell us a little bit more about your background. What got you into investing and your investing philosophy for that matter?
I started out in my family business in the 80s. I'm going to age myself here. In the 80s and 90s back in South Florida. And we had a flooring business, an Italian flooring business, where we sold ceramic tile and marble from Italy. And I would just, on my breaks or after jobs, and I would be having lunch or even dinner at the office. Again, I'm aging myself here, but I would read. I was just naturally attracted to reading the stocks in the newspaper. You know, this is before I was dialing up AOL, and I got hooked on it. So as the late 90s came around, and I already had been in the family business for almost 20 years. You start off early when you work for an Italian father. I was looking for a change, and I got started with Morgan Stanley Dean Witter on the retail side. Then they got rid of the Dean Witter name. I had my training in New York in the World Trade Center, which was really a very unique experience. And I had my first office back in West Palm Beach, Florida. I did that for several years. I worked, ended up specializing in bonds in Palm Beach. And then I even got into mutual funds with Dreyfus. But then my true love ended up being getting into trading. Working for a boutique outfit out of Manhattan. And that was really the best. And on the side, I always had a passion for writing. Seeking Alpha came up, and I just dabbled here and there. And this is where I ended up.
Now, Joe, I want to jump right in. In your most recent article covering Visa and Mastercard, you actually gave Visa a strong buy and Mastercard a buy rating. Now, with that in mind, since both these companies operate as global duopolies, what was it in their, primary financial, metrics or even their operational metrics that led you to, give Visa the higher conviction rating?
I don't give a lot of strong buy ratings. Both of them to me were already buys, but what made Visa the stronger buy, let's break it down into like a trifecta of metrics. One being price, valuation. But when we're talking about forward earnings, Visa does have a slight edge. They're somewhere around 25 versus Mastercard, I believe it's at 27. Again, so that's really, really tight. But Mastercard, you have to give Mastercard the benefit of the doubt in this sense, because they do have a slight edge on the growth. So consensus has multiples compounding somewhere in the mid-teens. I think it's around like 15, whereas Visa's around 12. So if you're on the bullish side for Mastercard, you say, okay, well, Mastercard gets that extra point. Okay. Also, going back to Mastercard, you might say, well, Mastercard has an edge on return on equity as well. They're around 4 times, I think in the 200% range compared to Visa, which is in the 50 area. But you have to recognize that now we're talking about leverage. Mastercard's leverage more than twice a Visa, somewhere around 70% long-term debt to capital, where Visa's around the 32 area. So for me, I like to keep things simple. I like the more efficient model that Visa offers. So I would choose Visa in that regard. So those were the three metrics that I looked at.
You also talked about how Mastercard's value added services. So they're, talking about things like fraud prevention for their customers, and they also include things like data analytics. Mm-hmm. And so with that in mind, now we're accounting for roughly 40% of that being its revenue.
Sure.
So with Visa maintaining a slightly higher profit margin, from an investor's perspective, yours specifically, obviously, is it better to own a company that's leading in the tech innovation, or is it better to have one that's just more efficient overall when it comes to higher profit margins and just that being their core business model?
I think what it really comes down to is more of a philosophy. So from Visa, right, let's say that they're the old model. Okay, it's still high tech, but now when you comparing it to Mastercard, let's say they're the new model. Okay, so now they're adding all these value-added services, like even consultation for that. Now, if you're an investor who appreciates that kind of expansion where you're offering more products can be more money, then that's something that you might be gearing towards. Again, going back to my personal philosophical approach to investing is always keeping it simple. And that's reflected in my writing. It's reflected in choosing Visa in this regard, because what Visa is doing is they're saying, okay, we really perfected this pipeline, so to speak, this system that we created. So now any more customers is already going into these higher margins. So they're already at high margins. They're already going to be getting more money. Let's use another analogy in this regard. Okay, let's take an Italian restaurant, right? So you have an Italian restaurant and it's simple. They make the best pasta. They only have like 12 dishes, right? And the chef, he runs the kitchen just right. And it's always packed, and it's always going to be the go-to. That's Visa to me. Mastercard, on the other hand, now they added all these other things, like sauces and pasta and all that. That to me is Mastercard. Even like, let's say, cooking classes. That's what Mastercard's doing. So they're expanding to become a complete payment system in that regard. But again, for my choice, I like simple, and therefore I chose Visa. So Visa gets extra points towards the strong buy in that sense.
Visa with the extra points. I love it. So I also want to dive into, when you talked about government regulation, there's an increase there. And that's actually kind of making these, global duopolies have like somewhat of a competitive fortress. So for any of those smaller fintech companies, why is it that this increase in government regulation is kind of allowing them to not be challenged by them at all?
Visa and Mastercard, they're the incumbents. They're not the disruptors. They're not the disruptor fintech that's coming in. They already laid the groundwork. And here, in this sense, I like to think of like relationships. So they not only have relationships with the government entities, but they also have relationships with the banks. Okay, they have the system in place. They have the base in place. So, and plus, regulation's not something new.
So they're not actually lending money to consumers. And with that in mind, as balances are continuing to rise and there's missed payments hanging in the balance, how exactly are these two companies insulated from something like a recession or a debt crisis? A lot of people are really concerned about where their dollars are going now. So how does that, translate to what they're doing?
They're a volume business. Volume is king here. Okay. They're about transactions and transactions only. But when we're talking about, the issues that you brought up, it's a macro indicator in the sense that, okay, well, if people are tapped out, okay, of their credit card, if they're maxed out of their credit card, well, guess what? They're not able to use the credit cards that they have, whether it's Mastercard and Visa, fueling the revenue that they get.
Now, I see here that Visa currently trades at a significantly lower free cash flow multiple than Mastercard. So does this lower valuation reflect a slower growth profile for Visa? Or do you think that the market is really underestimating Visa's cleaner balance sheet?
Two companies have really gotten neck to neck, and in price to cash flow, they're both somewhere almost exactly at 23 in those metrics. And you have to go back to the first question, really, what is the differentiator? What is it going to be? And it's going to be something, I guess kind of minute when we're talking about a strong buy and a buy. And in this sense, my overall opinion of these two companies that these are buy and holds forever. And when you're talking about these kind of valuations, when you have a better scenario in place, so to speak, those are the times to actually buy in. But in my sense, just buy and hold and let the dividends reinvest.
Well, I think we'll leave it right there. Thank you so much, Joe, Grassroots Trading. And for everybody listening in, go ahead, click the follow button to Grassroots Trading page on Seeking Alpha and take a look into Visa, take a look into Mastercard, see if that's going to be something right for your portfolio. And we'll see you here next time on another episode of Portfolio Pulse.